you all know who David Gardner is. He doesn't need an introduction of that kind, but I will say that we're really, really pleased that he was willing to do this for us, our very first online attempt at a speaker series. It came out of his generous desire actually to share with his own Morehead-Cain mentee some tips on getting started as an investor, and actually just the idea that as a young person you should be an investor. So not only is it how to, but y'all oughta, you know. And so he had been talking about that with us, and then Emily had the idea of why don't we make this available to all young alumni, and then the fact, of course, that it's David Gardner made us realize that all alumni and all humans would want to be part of it. So we decided to open it up to as many folks as wanted to join us. So we're very, very thrilled to have David with us today. And I guess what we may do is just let David take over and run with this. We do have a couple of questions that came in, but we can throw those out as needed and as desired. And also, you know, I could give a little more background on David as an undergrad and all those sorts of things, but I think he can sprinkle that in as well. If we feel the need to do any of that along the way, I think we'll do that. But I thought, what better to do than to just turn it over to David and let him start rolling. So David, thank you again for being here with us today.
My pleasure, Megan, and thank you. And thank you, Chuck. Yeah, I think a lot of this, once we become alumni, our main goal is just to make Megan and Chuck proud. So it's something that it's a lifelong quest. So it's always easy for me to say yes to any invitation from the Morehead, and it was a delight for me to say hello today to you on April Fool's Day, which of course is our national holiday. So it's perfect timing. A little later, I think I'll probably put on my fool cap, maybe for the Q&A. But just to start, I thought it would just be nice to start with a story from my own experience that I hope conveys to you the benefits and importance of investing. I know some of you are already investors, and some of you are investors, but you don't know it yet. And we'll talk about that a little bit later. But I define investing using the Latin term investere, which is the root from where the word invest comes, and it means to put on the clothes of, to wear the clothes. It's like priestly vestments, that's the same root. And we live in a world today where not many people are actually investing. Many are trading, so you see people throwing up pieces of paper on Wall Street and all kinds of minute-by-minute changing quotes. I don't watch CNBC very much, but whenever I do, or Bloomberg, it seems like they're showing a live stock market graph that's tweaking every second as you watch prices change. That's really the opposite of what we do. That's a frenetic short-term game. We're playing the beautiful game of investing. And the reason I love the root and start with that is because I think a lot of us can relate to when Carolina sports are being played, whatever sport it is, the fans who show up often are wearing the jersey. And whether our team wins or loses that day, we keep wearing the jersey. And if we have a bad week or a losing streak or a bad season, we're not going to change the jersey. And that's a pretty good analogy, a metaphor for how to think about your money and how to be invested. You should love where it is. It should represent who and what you are. And you should keep the jersey on in a world in which people are constantly trading, not investing. And that's just true of how it works on Wall Street today. The average mutual fund, and some of you may know what mutual funds are, and I'm not sure I knew what a mutual fund was when I graduated Carolina, so I won't make any assumptions here, but a mutual fund is a way that people pool money together and then have a professional manager manage it for them. And most of them are pretty mediocre. There are thousands of them. There are more mutual funds than stocks today. But the average mutual fund starts on January 1st with whatever it has. Let's just say it has 150 different stocks. And by the end of the year, it will have changed over 70 to 100% of those stocks. That's just the average mutual fund today. So you can see the way that institutions work and the way that Wall Street works, so very different from this very odd thing that I do, that I hope you'll do, which is called investing. And I wanted to start with this story. It was a couple of years after we started the Motley Fool, so it was the late 1990s, and my brother and I were at a local watering hole near Fool HQ in Alexandria, Virginia, and a guy walked in. He was dressed from head to foot in leather. He was about 6'5", a middle-aged guy, sat next to us, and we just said, well, you know, who are you? What do you do? And he said, well, I'm a Harley guy. And one thing that happens every year is around Veterans Day, lots of people driving on Harley Davidson motorcycles to the nation's capital. And there's a POW MIA thing, and there's a big Veterans Day Rolling Thunder thing that happens. And if you're in the DC area, then you'd be aware of that. But it's something that happens once a year. So that's where he was. That's why he was in Washington. That's where he was coming in from. And he said, well, what do you guys do? And we said, well, we pick stocks. We invest. He's like, really? Well, let me tell you my story. I only ever bought one stock. And we said, okay, tell us the story. He said, well, it was 1987. So I had heard the stock market had crashed. And so I took my life savings at the time, $5,000, and I gave it to a broker, and he put me in a stock, something like restaurants in the Southeast or something like that. And he said, I still follow it today. So it was a $5 stock. So I had 1,000 shares, $5 stock, $5,000. It's gone from $5 a share to 25 cents a share. And so my $5,000 is like $250. And what I've learned is, guys, said the Harley guy, the stock market's a great big gambling machine. And we said, well, it was my brother who produced this memorable line. He said, did you think of investing in Harley Davidson? And the guy said, no, really, I didn't know. Is that a stock? It's like, yeah, it's a public company. Well, what's that? Well, he said, it means you as a member of the general public can be a part owner of Harley Davidson. That's what stocks are. They're public companies. We went back and checked the numbers. Harley Davidson had gotten crushed in 1987. Had he bought it coming out of the crash, that stock had gone up 100 times in value between 1987 and 1999 when we had this conversation. Incredible 12 years for Harley Davidson. So if he had invested in what he knew, the Harley guy, if he invested in what he was riding and what he was surrounded by every day of his life, his $5,000 would have been $500,000, not $250. True story. And while it's a dramatic A or B fork in the road because of the performance of Harley Davidson, I hope it makes it evident what I kind of led off with, which is that I really believe that you should be saving money. And I really believe that you should be investing in the stock market. We can talk some more about that. And why do I believe that? Because the stock market rises on average 9 to 11% a year, depending on what time frame we're looking at. These are all measured in decades, though, not in years. And there's really nothing else that I can think of that has that kind of performance and has done so over the last century. So if you look at a graph of the stock market over the last century, it goes basically, I don't know if I'm doing this right off my camera, lower left to upper right. And that is going to be true the next century as well. There are lots of systemic reasons why stocks rise, but most of all, it's because of great businesses that come along and innovate and keep leveling up our consumer opportunities, lowering prices, and creating better and better stuff. When I was Skyping my kids good night from an airplane for free, I was thinking this is radically different from when I was at Carolina, when it was a collect call from David. My parents would take it and it would be about a $25 fee in 25 minutes just to call home from college. It's just a simple example. There are innumerable examples like this since I was your age and now that I'm my age, and it'll be true for you to your kids as well. So there are lots of great reasons why the stock market rises. It's not a great big gambling machine. If you zoom in on any 2-year period, it could look really bad. This year hasn't been a great year for investors. There have been a number of other periods in our 27 years of the Motley Fool where stocks have gotten really crushed. But it was always for just a couple of years, which is usually how long a bear market, which means when the stock market goes down, that's usually how long a bear market lasts. It takes a while to recover back and catch back up. But that 9 to 11% figure I gave you at the top, that includes every bad day and every bad year the stock market's ever had. And so that's why I feel urgency for you at your age. And I'm speaking to me and Chuck and Megan, and mostly I'm speaking to my fellow Moreheads, undergrads much, much younger than we are. I feel urgency for you to get on the train, because that train that goes up the mountain, 9 to 11% a year, the earlier you get, the earliest station you find, the earlier you get on that train, the happier you're going to be years and years from now. It's one of those 10-year overnight success stories that happens. 10 years from now, you'll look back and you'll say, wow, I'm really glad I did that. And one of the beauties of the stock market, and then I'm going to shift my talk a little bit or open it up for questions, Megan, if we have some from that. But one of the beauties of the stock market is your money works for you. You don't have to do a lot of work. I love the work that I do, and maybe I'll talk some about that this hour. And I know most of the people who are adults who have jobs on this call love the work that they do. And a lot of them have been doing it for a long time, which is usually a pretty good sign that they love what they do. And I think that's really important in life. And I'm blessed to have found something that I love to do and I could do every day for the rest of my life. But I don't have to worry too much about my money. I'm just invested in the stock market. And every 2 weeks, I save more of my salary, goes right into the market, good times and bad times. So part of the beauty and secret to stock market success is just that you don't have to do a lot of work. And especially at the Motley Fool, the way that we've always taught investing, we tend to buy and buy and buy and buy some more again and rarely sell. And there are some really good reasons that we can cover later if that's of interest to you. There's some really good reasons why that's the best approach for your money. But most studies show that looking at real life brokerage accounts of people, that the people who prosper are those who sometimes look like they're asleep at the wheel. And then the people who really underperform or lose money, even over long periods of time, are jumping in, jumping out, using a rear view mirror to make their forward money decisions, and also spending a heck of a lot of time at it too. So, which is sad. So that's a little bit of a call to action for investing. And, you know, one of my watchwords is make your portfolio reflect your best vision for our future. So I think that the most satisfying way to invest is what I've done, and it's been very satisfying for me, is to think about what's awesome and then get my money there. And then when that thing becomes awesome over the next 5, 10, 15 years, you have the pleasure of having a better life because Amazon grew up overnight over 30 years and became such an important company. So not only did I prosper by getting in very early, but I also really appreciate, especially in these times, somebody coming to my door and dropping off a package. So I think that Amazon is a hero company. It's always controversial for some, and big companies are always going to get questions about some of their practices, which I can appreciate. But take it all in all, I think Amazon is probably my favorite company, and that's including my own company. So you might not like Amazon though. Great. So what do you love? You should have your money there. So let me pause because that was about a 10-minute blast. Megan, do we have some questions? Do you want to flash any my way, or do we want to keep moving? I've always got more.
I'm happy to let anybody jump in with a question first. If anybody's got something on their mind right away, just unmute yourself and jump in. Or if you want to, you can raise your hand. You know, if you know how to do that under the participant section. But I heard a noise. Somebody's talking.
Great. I see Nina saying, how much would you recommend a young person start investing with?
Great.
Great question. So to be a little bit funny about it, I'll say $1. And why do I say that? Well, a really remarkable thing has happened in the last couple of years. 2019 will be remembered in large part by investors because that was the year that commissions became free. Now, I'll assume not everybody knows what a commission is, but basically, if you buy a stock or sell a stock, up until 2019, you would pay money for the transaction, like most other things when we transact. And it would be, 30 years ago, it would be like $50 or $100. So you better have maybe $1,000 to invest because you're really getting hit with a $50 fee. That's like 5% off your money right there. Good news, it's free now. Most brokerages have shifted, with Schwab's leadership in particular last year creating a bandwagon effect where now there are no commission fees. And then the other important trend that's happened in 2019 into 2020 is the ability to buy fractional shares. So let me take a quick live stock market quote right now, since I mentioned Amazon. Amazon stock is trading at $1,931.75 a share. So if you wanted to buy one share, it would cost you about $2,000. However, up until 2019, that was real. You'd need to save a couple $1,000s to buy one share of Amazon. But the world has now shifted to fractional shares where you can buy 1/100th of a share of something, or not even round numbers, 0.157 share of Amazon. And that's free now. So it's an incredible conflux of two factors that had never been the case before, that were dramatically different than when I was a Carolina senior. And it has now enabled anybody to basically get started. There are some minimums. Sometimes certain brokerage firms, and by the way, opening up a brokerage account is as simple as opening up a bank account. A lot of people do that and learn how to write a check in high school. And I'm not even sure we teach that anymore because there aren't that many checks being written, but at least some of you may have learned how to write a check or written checks. It's a little bit of an idiosyncratic thing these days. But yeah, that was pretty simple. Actually, that was harder than opening up a brokerage account. You can online, some people use firms like Robinhood, which is an app that does free trading. That's come in under a little bit of problem because it's busted a few times, like it crashed during market volatility, which has been extreme over the last few weeks. And there's some questions about Robinhood, but regardless of whether you want to look at Robinhood or Schwab or any number of different possibilities, they'll have an online form that you fill out, and then you write a check or deposit money by wire or Venmo probably, or whatever makes sense, and you can open up the account that way. And again, some firms will have minimums, like you have to have a minimum of $150 account. I'm not really sure. So it's going to be different from one firm to the next. But that's a great question, and thank you, Nina. That's kind of a really basic question that it's important that I speak to that. Let me see a few others here. So Harrison, you're asking, should we invest on a regular basis? Should we allocate a specific portion of our income to investment? So yeah, I love the idea of investing on a regular basis. So I've gotten a few young friends started recently, and at least one of them says, hey, I'm just going to put in $5 a week, which I think is amazing. I mean, it's kind of the cost of one cup of Starbucks that you're foregoing on a weekly basis. But if you do the math, that's $250 a year. And if you do the math compounding numbers at 9 or 10 or 11% over long periods of time, you'll see that really those are very expensive cups of Starbucks when you consider the opportunity cost. Now, I'm certainly somebody who's not telling you not to have fun in life or spend things on things that give you joy, especially during this stressful period. But I also think it's such a good thing to feel like you're regularly putting money in. And so it really can be, when you say, is this what specific portion of our income, what we usually tell adults when they get their first job is to try to save 10% of their salary. That's aspirational for a lot of people. And a lot of people have student debt. They're just trying to pay that off for the first 5 to 8 years of their adult life. I'm happy to say, because of John Motley Morehead, that a lot of us don't have that problem. So you've got a real accelerant relative to most people who are your age. But 10% is aspirational. If you can go more than that, which is usually possible later in life, that's awesome. Some people are just great savers. I don't think I was a particularly great saver, but part of my own story was that I had a dad who invested for me when I was a kid. Actually, when I was born at age 0, I didn't know it, but dad started investing for me and kept it going. And when I turned 18, not only did I get a Morehead, but I got my brokerage account from my dad who'd invested, putting on the clothes for 18 years. He did really well for me. Not so well that I didn't need to get a job one day, but well enough that I didn't need right away to get a job, which in a lot of ways was what enabled the Motley Fool to start without getting any outside venture capital, which is a fun part of my story. But anyway, so I think that saving and investing on a regular basis should be a habit. And by the way, I don't know if there are any James Clear fans out there, but James Clear wrote a great book called Atomic Habits, which was published in 2018. And I'm going to put in a plug for that, because not only is James pretty genius about how your habits shape your character, he never does rock the great Ralph Waldo Emerson quote, sow a thought, reap an act, sow an act, reap a habit, sow a habit, reap a character, sow a character, reap a destiny. It all starts with a thought, an act, but James speaks so well to the power of habits. And the reason it's a plug is because I interviewed him for my weekly podcast yesterday. So that comes out today at 4 p.m. It's about an hour-long conversation interview with, I think, one of my favorite writers and really smart people who speaks so practically to each of us and just speaks to the power of what are your habits and how to change your habits. And ultimately, what James is saying, and I realize this is a mini rant, so I'm going to get back to questions, but ultimately what James is saying is it's actually about your identity. The best way to change your identity is not by all of a sudden hoping to be different or trying to be different. It's the habits that you show, what you're bringing every morning at 9 a.m. or every night at midnight. That's going to be how to shape your identity. And sure enough, you can change your identity for the better. by observing your habits and getting some new ones. Anyway, so the habit, Harrison, of investing on a regular basis is very powerful. Probably one of my very favorite habits. If you do the math, there are going to be few habits that are more valuable over the course of your life than that one. Saving versus investing. I'm just going down the questions here, but wait, I see a voice. I see a face.
Yeah. So thank you. I'm Harrison. I was the one who asked the question. I appreciate the answer. Just before we move on real quickly, while you're talking about personal finance, I see one of the next questions is talk about an emergency fund. What do you think about investing versus, saving for an emergency fund, doing employer matched 401ks, and investing in like a Roth IRA before you get to investing in the stock market?
Yeah, so that's great. Thank you. And clearly, Harrison, you're somebody who has a background or interest in this. Most people are not rocking those key jargon phrases that show that you're speaking the language of the court here when we talk about investing, Roth IRAs, et cetera. I won't break down everything that you just said, but I will speak to it by simply saying that, yes, we do believe that it's good to have a so-called emergency fund. And the way of thinking about that is, what is the cost of your living for a given week? Just kind of knowing what that is. And it's very different for each of us. We're all in different situations. And then multiply that by 12 and think about 3 months. So kind of at a minimum, do you have that amount saved? Now, again, most people don't have that amount saved coming right out of college as a senior. The good news is, though, you have a pretty lower number than somebody who's trying to support a family, et cetera. But we do think it's very prudent to have money saved up. But I also believe that, even though my kids are now mostly out of college, we have one who's back from Vanderbilt in his junior year these last few weeks. But most of my kids are now out of college. But if they had a real emergency, I would step in and do something for them. Right? So I think you can lean on your parents, depending on your relationship with your parents. And I'm not making a joke there. It's different for everybody. But I think you can probably lean on them some. So I would want my kids, and I have had them, basically any money they have invest in the market, we got your back here as a young adult. So if that's your situation, I wouldn't emphasize emergency fund too much. I'd get invested some more. But if you find yourself independent, autonomous, without that kind of support, or fast forward a little bit with kids, then you definitely should have that saved away. You never know what's going to happen, and it's really great. Think about how many people have gotten layoff receipts here in the last few weeks, and a brutal March and brutal April coming. And I hope it'll all get much better by the late summer. But, it's really good to think that you have yourself covered there, Harrison. So there's a quick answer, or maybe not so quick an answer. Your good question. Thanks. So, we got these chat questions. They're great. I think I should spin through the 5 that I see here as fast as I can. So I'm going to go 1 minute each. And then let's open it up, because I think it was fun hearing from Harrison, and there's so many bright people on the line. I think it'd be great to have some back and forth with video. But let me go real quickly through these questions. So Lauren, it's great to hear from you again, Lauren. Lauren did her summer internship at the Motley Fool a couple of years ago. She said, I've read, and she's talking about the emergency fund. Should we always prioritize getting that fund complete before jumping the stock market? Okay, good. I think I just spoke to that one, channeling Harrison, as we talked about the emergency fund and how to think about it. So it's just a great concept to have in play in your life. But if it involves a conversation with your parents to see if they have your back and are ready to get started investing, or if not, then you should be thinking about having yourself covered. Obviously, the chances of us having a really bad medical situation at the age of 21 are way lower than 53 or 71. So, act accordingly. Larry, you don't have as much experience investing in commodities. What do I think about that? I don't have much investing experience in commodities either. So I think that you can go through an entire life and not be a commodities expert. Some people are. Some people study oil for a living. They have thoughts about gold or about pork bellies. There are huge markets just dedicated to figuring out where the price of one of those commodities will be in 1 or 3 years or 1 or 3 months. But for a lot of the stocks that I recommend or am invested in, they might be based on a commodity. They might need that commodity to do well. There's a great company called Nucor Steel, which is a North Carolina company. Steel is really important in Nucor. But I've typically found that I'm not going to be great at those kinds of stocks. So my 1 minute answer there is, you really don't have to know that unless you want to go into that, I would say, for a living. Because a lot of people who are professional traders of commodities or just focus as an analyst on something, become an expert. That's a very worthy calling. It's just not my own journey. Charlie, thanks for helping out. I saw you with the mask earlier. It looks like you were helping out your local community. That's amazing. Insight on safe, good dividend investments. Yeah, sure. Let me just speak briefly to what a dividend is. And this is a 1-minute answer, so here I go. So some companies, out of their profits, typically, will decide, rather than just reinvest that money in its own business or keep it in the bank, which is a good thing to do too, just like it's good to have something saved in your bank account too, those companies decide to pay a portion of those profits out to people in the form of a dividend. So if you own a share of a company, you'll get paid back maybe $1 a share. Let's just say the stock's at $33 a share, and you'll get $1 back for owning the stock. That comes from the company's pool of money and profits that it's generating. And what that means is, if the company can just keep paying that every year, the stock probably can't decline that far, right? Because if it went from 33 down to 15, it was still paying you $1. That's like a 5% interest rate for holding the stock. So that provides, which would be a very good deal these days, right? So that provides some safety and stability to companies that pay dividends. It's not as much my focus. I prefer to find companies that typically use their money to reinvest in themselves and grow their businesses. So I love growth companies. I love companies like Netflix, which don't pay a dividend, but really create great returns for shareholders because they have so much good stuff to reinvest in, like taking over the world with streaming, which is what Netflix has been doing the last 10 years. So again, to close that one, Charlie, not as much my orientation, but we certainly have information about that at the Motley Fool. And if you Google Motley Fool dividend stocks, you'll see lots of examples. I mean, I'll give you a quick example of one, 3M. So I love my Post-it notes. I've got Post-it notes all over my office. 3M invented the Post-it note, and they pay a pretty good dividend. So usually it's more staid, slower growing, long time companies that pay dividends. And especially as we get older, more like my age or Chuck's age, less your age, I think dividends are more and more helpful as we transition away from having a salary into needing income on a regular basis. But I don't think it's that important for you at your age, unless that's, what color your parachute is, in which case I think that's awesome. And then just Robert and Michael. Robert, does it make sense to pay off all grad school debt first? A lot of questions about paying off debt come down to the question, what is the interest rate on that debt? And typically, student loans are pretty low interest rate, which means, and you're investing in something that's really going to grow you, and from a financial standpoint, probably your earnings power. So it's good debt to take on. I'm the first to say, if you can get away with not going to business school, which is somehow a trick that I pulled, it's a great trick. So if you can somehow not feel like you have to go to grad school and still feel like you can learn from the school of hard knocks in life and instead get paid as opposed to paying, then I'm a fan of that. But a lot of us go to grad school for great reasons, and I don't think you need to pay off that debt first. If it's single-digit interest rates, if you think about the stock market, even though it goes up and down, it's volatile. If you think about the stock market rising, 9-10% a year, and you're paying student debt at, let's say, 5%, I'm making that up, round number. Do the math. You want to pay that off slowly, and you want to. I still like to pay off my debt, of course, and I like to feel comfortable and sleep at night. So if it were burdening me, I would accelerate that. But you fairly safely over the course of time can invest alongside low interest rate debt. The opposite of that, of course, to close my 1-minute answer, is credit card debt. You should always be paying that off in full. You should not allow anything that's double-digit interest rates. One of the old saws is those who understand compound rates of return. I mean, let me flip that around. This is an old saying that I love, and I'm getting it slightly wrong, but it's those who are paying high rates, double-digit interest are, okay, I'm chugging. Basically, the people who understand it are getting paid by the people who don't understand it. That's the key concept. I'm not as, I guess, I think it's now time that I should put on my full cap as I stumble and bumble my way through that particular old saying. But the idea is, yes, those who don't understand compounding are condemned to pay to those who do. So yeah, it's the bankers getting your 15% credit card interest rates who understand the benefit of that, getting paid by people who didn't understand it. And I'm not saying people didn't understand it, but a lot of times they have bad habits or they have a tough life circumstance. So not going to sit here in judgment of anybody, but darn it, get rid of that double-digit interest rate if you're paying an interest. But at the same time, if it's education, then that's usually single-digit and awesome. And then Michael, recommendations to invest in. what you know, almost fall asleep at the wheel. Do we not need to learn technical analysis? Well, that's a funny one. By the way, my fake background plays havoc with my fool cap, but I'm going to just own it and have fun with it. So I would say that I've spent no time doing technical analysis, Michael. This is more of a 101 topic, not an investing 10 topic. So I don't think we need to go there, but basically technical analysis is an approach to the stock market where you don't really know what the company does or care. You're looking at the graph of the stock and you're looking for patterns in the graph. It's usually very short-term oriented. People who are thinking about trading over the course of a few weeks or even inside a day. And you look for certain patterns, like if the stock over the course of a trading day went up to, let's say, $32.70 a share and then dropped down below it and then went back up to $32.70 and fell down below it, you start calling that a resistance point. It starts becoming a thing. You're like, well, every time it goes to 32.70, it's probably going to go down again. So people are waiting for it to go there again, and then they're going to sell it because their belief would be that since it's already gone up there twice and failed to cross over, that it's going to happen again. And so that would be a typical example of technical analysis. There are elaborate terms for different patterns that you see in graphs. Suffice to say that it's not something that I use. I don't really believe in it. It's almost like a religious thing for some people and anti for some others. So I would be on the other side of that one. But I mean, you know, there are lots of different people who use it. It's just antithetical to what we do at the Fool. So that would be my response. And thank you all for good chat questions. So Megan, I see it's 33 minutes past the hour. I mean, I'm enjoying answering all kinds of questions about investing. You can just keep going all hour. Also happy to talk business or culture or any kinds of stories there. So I'm going to go silent for a little while, see if somebody wants to come forward with something.
Yeah, that'd be great. If anybody doesn't mind being seen and heard with a question, that would be kind of cool too.
Can I ask, this is Charlotte. I was class of 2013. And I actually, it was funny, I was on with a group of fellow Moreheads last night and we were debating a bunch of stocks and industry trends. And so I was just curious, you kind of building on the last point, how you go about assessing risk and reward of certain stocks. And so last night we were looking from an industry perspective, so cybersecurity, electronic payments, and then we got into certain stocks like Boeing and just advice in terms of how you, and I know it's not an easy thing to do, but assess risk versus the reward of certain stocks and approaches.
Thank you, Charlotte. Great question. What is that behind you, by the way? Where are you?
I am quarantining in the North Carolina mountains, so as far away as I could get.
Beautiful. I mean, it looks good. And you're a little bit backlit, but I think I see you smiling. No, that's okay. You don't have to.
An Uncle Mott shirt too. I have
awesome. Looking great.
Yeah. Race that I actually did not manage to run because, like a lot of us, we're not up early the morning of the alumni forum race. So.
Yes. I'm one of those. I'm a total night owl and also a lazy bum to boot. But so thanks for the question about risk. Yeah. So I'll give you two quick answers. The first is that I decided that there were no risk ratings for stocks. Like for people who are familiar with it, there are risks ratings associated with bonds and lots of other investment vehicles. But for whatever reason, stocks had never had that. So I decided just to create my own system, which I've done, which is a 0 to 25 point system. And I've done a series of free podcasts about it. So if you find yourself interested, you could Google Rule Breaker Investing Risk Ratings. If you were a member of Motley Fool Services, our most common and lowest priced one is Motley Fool Stock Advisor. We calculate risk ratings for all the stocks. And it's also a transparent system. So once you see the 25 points, you can do it yourself for any stock. So that was really important to me. And I love the system that we built. And it's a really simple system where we ask binary yes or no questions. And we ask the same questions of every company. And every yes is good and every no is bad. And so if you get 7 no's, then you have a risk rating of 7. The higher the risk rating, the higher the risk. And so I basically built my own homebrew system to do what you were talking about with your friends last night. The other answer is that I think that risk is just a natural for investing. It's important that it exists. If it didn't, we wouldn't have winners. Usually most of the great stocks of our time, just think about Netflix, which we've held since 2004. So it's been amazing 16 years. Over that amazing 16 years, more than once, Netflix lost 2/3 of its value and often pretty fast. It hurt a lot. And Amazon, I first bought it $3 a share. It went to 95 5 years later. Then it went to 7 the 2 years after that. So my 30 times return dropped from 95 to 7. That hurt a lot. But again, if you heard me earlier, I tend to buy and I tend not to sell. And if you're finding excellence and looking for excellence, which sometimes involves risk, then I think you're going to be rewarded, but you also have to be willing to lose. I might talk later and queue up like all my losses and all my bad stocks and how bad I am, because there's an important lesson there. But to try to keep it quick, risk is really important to me. We have a system to measure it. It's homebrew, but it's a guidance for people to understand the real risk. And the final answer is those who understand balance sheets, and some of us probably for a profession look at balance sheets, a lot of it comes down to the strength of a balance sheet. It's just like, how much money does the company have and how much debt does it have? And Boeing isn't a great kind of a situation and not the kind of stock that I would invest in anyway. But, and it's a little bit of a coin flip and like, will the government step in or not, right? You're just kind of guessing. And I don't like to be in situations where I'm guessing. So just like if you could see the balance sheet of 2 Carolina grads, one of whom had a ton of debt and nothing saved, and the other was the exact opposite. Which one would you invest in? Which one is the better risk? And I would always invest with the latter. And I just wouldn't bother with the former because there are too many better balance sheets and situations to invest in, and we don't have to invest in everything. That help?
Yeah, that's great. Thank you. And just one quick question following up on what you said. How do you decide when to sell these stocks that you sit on for a long period of time?
I almost don't, in the sense that why do we invest in the first place? The answer is usually to do something. Maybe to put a child through school, take a trip around the world with your 3 best friends, retire early. And so for the most part, I just let that time in my life decide that I'm going to sell now for this or that reason. It's not to say I never sell. And what I do sell, if you were to see my sells, my personal sells, which maybe I'll have a couple each year. And by the way, I have a stock portfolio and I manage my kids' portfolios of about 50 stocks. So some people have 1 stock and some people have 138 stocks. I have about 50. So in a given year, I'll have a couple of sells. Very low turnover. Usually those are companies that either A, were bought out by somebody else, so I sold them. Like I just got paid out in cash. Or B, were really bad stock picks and just did not work out. And so what I'll usually do is I'll take the capital loss of that investment and I'll tag it and match it against one of my big winners like Netflix, where I have too much Netflix because it's done so well that it starts to take over my portfolio. So I start to reduce a little bit my exposure to big positions and I'll take the losers out and so if I lost, let's say $10,000 on a really bad stock, I'll sell $10,000 of Netflix and net those out to 0, which is a way to keep my capital gains bill at 0 each year. So that's really when I sell. Very infrequently do I sell for any other reasons than that. And by the way, this is an extreme view, so please know I sound like a freak to a lot of people in the financial industry when I say this, and yet we've done it transparently out front of America for 27 years on our site, and it's worked really well. And people like Warren Buffett before us have demonstrated it works pretty well, so I feel good about it. Thank you. Who else?
Hey, David. I'm a junior at Carolina, class of 2021. And one question I've kind of been wondering is from stuff I've read that rather than picking stocks like Buffett or like the Motley Fool, what about investing in like index funds or S&P 500 ETFs or total stock market ETFs? What would be the insight in choosing specific stocks as opposed to an index fund?
Yeah, great, Jay. Thank you. And so we're really good at speaking on both sides of our mouth, and I think I've already done it some in our 41 minutes together because I like to make sure people see both sides of something. So I'll do that briefly here. So some of our advice that has probably activated more people than most other parts of our advice over 27 years is start with an index fund, buy an index fund. So for those who don't know index funds, and I'll assume at least one of us doesn't, so let's make sure we all understand it coming out of this call. An index fund, I described a fund earlier where a lot of people pool money. Let's just say all 62 of us have saved $1,000, and so we put $1,000. Actually, let's make it a lot. We've all saved $1 million. So we have $62 million, but we don't want to manage it ourselves. We're busy. We don't feel confident. So we give our $62 million to a fund. And so that might be a robot and like an algorithm, or it might be a human manager, and there are good arguments for both. But that manager takes our $62 million and maybe puts it in 100 different stocks, and maybe takes, 1/62 of each of those, or actually 1/100th of all that $62 million, and has it in equal 100 positions, right? So that's a fund, that's a mutual fund. Some of them are managed by humans who are making choices. Some of them are managed by computers that are just mechanically doing stuff. And our favorite are the latter, the computer managed funds that are just buying everything. So there's one called the Vanguard Total Market Index Fund. It basically, I'm making this up, if there are 3,500 stocks of real consequence on the stock market today, it takes all of the money, and we're talking about at this point trillions of dollars. It takes all that money and puts it in equal amounts in all 3,500 stocks. There's no thinking going on there. Every good and every bad company is in that, and that's called an index fund, because you're basically mimicking an index. In this case, the index of the whole American stock market. Now you could do the index of, let's just say, European stocks, or you could do restaurant stocks, right? There are all kinds of different indices, and sometimes they're called exchange traded funds as well, very similar to an index fund, but we're getting into the weeds. So basically, do we like index funds? Yes, we do very much, Jay, because they're very cheap. Computers don't have egos. They don't look for bonuses. They can manage at like a penny on the dollar or a tenth of a penny on the dollar in terms of the fees that you pay, because everybody pays fees to be in that $62 million fund that we were all in. In fact, typically, a typical fee would be around 1%. So that means if you and I each put in $1 million, we just paid $10,000 to have our money managed this year. And most Americans don't even think about that or know that. They save money in a 401k, they put it in funds. They don't realize they're paying fees, as well they should, to a fund manager. So we love index funds because they keep fees really low, really low. And they actually tend to outperform the humans that are making backward-looking, frenetic decisions a lot of the time and are charging quite a bit more. And so Jack Bogle, who founded Vanguard, the recently dearly departed Jack Bogle, whose Princeton undergraduate thesis paper was about how there should be these things called index funds, which he wrote, I think, in the 1950s. And he then spawned the industry that we're talking about. So we love index funds. That's that side of my mouth. It's, for most people, it's much better than what they're doing otherwise. But then on the other hand, as we wrote in our very first book, The Motley Fool Investment Guide in 1996, we don't invest in index funds. We think you should be buying stocks. We love buying stocks directly. Why? Because I think we can buy the good ones and avoid the bad ones. Everybody else, because indexing has become so popular today, Jay, as you may know. I mean, there are huge amounts of money just moving around with index funds mechanically. And so I think the game is going to be won by the people who actually do care and do think that Carolina basketball is better than NC State basketball and Clemson basketball and Wake basketball, well, most seasons anyway. And so turns out by exercising human decision-making, in my experience, playing the game differently from how people are playing it, we can beat the market. And that's really the story of the Motley Fool over 27 years. We really have beaten the stock market. And most people are coached or taught, even in school, that that would just be luck. It's just monkeys throwing darts. We totally disagree with that. And I think we've kind of proven it over time. But so there you go, Jay. Maybe an overlong answer, but if I went extra explaining funds and index funds, I'm glad I did for anybody who didn't understand that, because it's good to kind of know the lay of the land before you start.
Thank you so much, David. That makes sense.
You're welcome. Thank you.
Hi, I'm Shreya. So
Hey, Shreya.
just to branch off the question about index funds versus buying individual stocks, like I understand that, like say that I wanted to keep an asset allocation like 80% US, but then 20% international. So like in the US, I understand the companies, like I'd want to invest in those stocks because I know them. But when we're talking about the international market, would it make more sense to invest in, say, like Vanguard's International Total Stock Market Index Fund?
It often does, Shreya, and a really good point. Now we've definitely leveled up. By the way, as a lifetime video gamer, I love leveling up, and I'm a gamer. Like behind me, my fake background blocks out 837 board games that I have in the room around me. So I love games, and leveling up means a lot to me. So we're leveling up this conversation. We're starting to talk about international index funds. But sure, you're right. It's harder. Like I know my American income is much better than the rest of the world. So I feel more confident buying stocks directly of American U.S. companies. Often, by the way, as you'll know, Shreya, a lot of them have international business. Like a company like Coca-Cola sells more abroad than it sells domestically, for example. So a lot of times we think about good old-fashioned American names or stocks, and geez, they're multinational players. In fact, here's a really interesting stat. Of the world's 100 largest economies, 69 of them are multinational corporations. It's an incredible transformation that's happening. Some people are troubled by that. I actually think it's pretty awesome because I personally trust Apple and its $100 billion a lot more than I trust some of the developing world dictators and what they're doing with their economies, right? So it's a really interesting fact today that some of the biggest economies are just great corporations, like some of the ones we've talked about this hour. Anyway, I validate what you're saying. I think that's great. I also love my international stocks too. So one of my favorites is Mercado Libre. It's been a great performer, and that's a stock I'd love to buy today, and maybe I will. Except that we have a requirement at the Motley Fool that if we talk publicly about any stock, we can't buy it for at least a couple days. So by just mentioning it here in this public forum, I won't be buying Mercado Libre, but it's one of my favorite companies, and it's basically like the Amazon, eBay, and PayPal of Latin America. Not only does it have a great last 10 years of performance, but think about the developing world, Latin America. There's so much more still to come. So Mercado Libre is an example of a wonderful international company, as good as any U.S. stock I can find. But I hear you on the Vanguard, international index funds.
Thank you.
Thanks. You bet.
David, it's Megan again. When you bring up sort of rules and things that you all have, maybe about how you handle things at Motley Fool, it reminded me of, I know a lot of our undergrads in particular are super interested these days in working for a great company that values its employees as human beings, and work-life balance is super important to everyone. And I just know that you all are just award-winning and way out front in that sort of wonderful work culture. Can you address that for a moment for everyone?
Sure. Thank you very much. I mean, we basically built a culture up over 27 years. And how did it start? It started when we came out of college, Carolina, and we're like, okay, so we're going to start a company, and who are we going to hire? And we didn't have enough money to spend ads on LinkedIn. Well, actually, LinkedIn didn't exist. We didn't have enough money to buy classified ads in the Washington Post, our local newspaper. So who did we hire? We hired our friends from college. So one of my brilliant Morehead contemporaries, Jim Surowiecki, some of you may know James in his book, The Wisdom of Crowds. He's a very talented journalist. His first 6 years or so, his teeth were cut online with us at the Motley Fool. So we hired Jim. So if you start hiring your friends from college, here's what you're not going to do. You're not going to say stuff like, Jim, you got to be here at 9 a.m. You got to stay till 5 p.m. By the way, you only have 5 vacation days your first year, right? None of that made any sense to us, given the context. And so we started a company that was like the uncompany. We didn't count anybody's vacation days. We still don't 27 years later. We don't actually care if you're in the office or not. As it turns out, COVID-19 has created a Zoom culture. By the way, Zoom is an amazing stock and a company that I think you should be considering buying. It's already done really well. As you'd expect, it's actually thriving in an environment that's very hard for most of us. But Zoom is beautifully set up, and I love that company for the next 10 plus years. It's one of my most recent stock recommendations, even though it's already more than doubled over the last 6 months. But anyway, so we basically created a collegial sense of trust at the Motley Fool, and that's been important to us all the way through. So I do think it's really important to, and I know I'm speaking to a generation that wants to feel great about what it's doing, where the purpose of what you do is more important in many cases than the profit that you might earn. And I certainly get that because I'm on the national board of something called Conscious Capitalism, which if you don't know that phrase, you can Google it. And you'll see that the 4 tenets of conscious capitalism that companies like the Motley Fool try to abide by every day. The first one is purpose over profit. So some of my favorite companies like Patagonia, just have always gotten this and have always done it really well. And that's what we've tried to do at the Motley Fool. And I think that's what the generation that I'm speaking to largely on our call today feels, right? So I think the world needed it. There are lots of reasons that we're there. Arguably, we always should have been doing that. But some of the excesses of capitalism, some of the bad players who sadly typically get the headlines, like Enron, have kind of opened people's eyes to how bad capitalism can be done and how destructive it can be. At the same time, it's when properly practiced, it's a very beautiful thing. So I wish for each of you that you find a workplace where you feel not just trusted, but loved. That's a word that we're very comfortable using around the Motley Fool. A lot of us, we have about 415 employees today. A lot of us have given the better part of our lives to the company. We have a lot of people who are 20 plus years at the Fool and are still pretty young. And so for me, it's deeply satisfying. It also gives us, talk about risk. We're a less risky enterprise when we have that kind of tenure. Megan, I think that loyalty counts for so much. I think again about Chuck and Megan and how when I was at Carolina, we were reporting to Chuck and Megan, and you all are this year reporting to Chuck and Megan. You just think about the benefits of that for the Morehead, for all of us. So loyalty runs deep for me, and I try to show the same loyalty, of course, to my stocks, the ones that really earn it. You know, great companies that do great stuff. And I want to work for a company that earns my loyalty. Often we've said at the Motley Fool, the first 5 years you're at the Fool, you kind of need to prove yourself to us. Ever afterward, we kind of need to prove ourselves to you. Both giving you growth opportunities, doing things that you're proud of, and expanding in the world. We'd be the first to say, we need to earn your trust every day. So there's a lot more I could say about the Fool and our journey. There's an amazing experience. I'll just give a quick example or a teaser. I know we're going to start running out of time really fast. But we took in $56 million of venture capital in the late 1990s. And about 5 years later, after 2001, everything crashed and we crashed. We started wondering, what are we going to do about that? Because other people had some ownership of our company and they ultimately wanted us to go public. And we didn't want to go public. We were kind of a wreck at the time. And we noticed in the back page of our venture capital agreement, something we really hadn't read or thought much about when we signed it about 5 years earlier. And it said, basically, if you don't sell your company or go public, like if you don't give us an opportunity to get that money back after 10 years, it will convert to a loan at 5% interest, compounding. And somewhere around 2001 was when everything crashed. So somewhere around 2003, 4, we're in year 6 or 7 of the agreement. We start looking at it going, wow, that's going to be hard. We need to pay back over $100 million that we don't really have right now. Now, a lot of the other companies that signed those same agreements and those funds were gone. A lot of the dot bombs were disappeared. We were actually still rowing the boat, you know, keeping things moving. But we started to realize that we could renegotiate some of it, transition it, and we went through a long winter from 2005 to 2014, in which we ended up paying back 9 figures, 100% out to all of the VCs and lenders, and became fully autonomous, I'm really happy to say, on 6 years ago this day, April Fool's Day 2014. And so there's a whole entrepreneurial journey that I love to talk about that wasn't as relevant today, but I do want you to know the importance of resilience. So I know some of you are already entrepreneurs, social or for-profit, and my own experience, which I would be remiss if I didn't mention toward the end of this 1 hour with you, is just the importance of resilience and, you know, playing the long game and always playing the long game. I've always said to every one of our employees, I hope you're the longest thinker in the room, because it puts you in rarefied air, rarefied space when you do. It also puts you in the best space to succeed over the only term that counts, which is the long term. So as investors, to go back to that, we're going to take short-term hits all the time. My own portfolio, my net worth declined by 26% from February 26th to March 14th. That doesn't feel great. That's like 3 weeks where a quarter of everything I had in the world's gone. But I've seen that before. And I know that's how the game is played. And that's kind of how it works. And I have an emergency fund. At this stage of my life, I sure should, and I do. So I was okay there. And it's only money in the end. But it's the same story of the entrepreneurial journey, taking short-term hits, but playing the only game that counts. I guess I want to say one more thing and then maybe a final question or two, Megan. But, you know, workplace engagement is a really important thing for the Motley Fool. So you're kind of speaking to that, Megan, with culture and engagement. And I want to give everybody a stark fact, and then I want to brag just a little bit here toward the end of our hour. So the stark fact is that in the United States of America, last year, Gallup, which every year has taken the temperature of engagement in American business by asking people basically, are you engaged at work? Do you love what you do? Do you believe in what you do? Are you excited about going there every day? Or the opposite? Do you not like your company, or in between? And so last year, 2019, we hit an all-time high for American workplace engagement. And that was 38%. So this is taking everybody. This is like all the companies. And that means that if you think about it as a boat, 4 in 10 Americans are paddling forward for the company they work at. The numbers show 4 in 10 behind them just have their paddles on their laps. They're just sitting there and they're just kind of along for the ride. And 2 of them in the back are actively going like this, paddling against the enterprises where they work every day. And that was the all-time high. So the little bit of bragging is that at the Motley Fool, we're at 91% engagement. So that means that we have 9 out of 10 people paddling forward. And we have 1 dude, which is a gender neutral term, 1 dude in the back just with a paddle on his or her lap. So what it took to do that and what it takes to do that is a lot of effort. And it doesn't happen fast, but the benefit of doing that is profound. The ability for us to turn our boat or to go get somewhere fast if we need to is remarkable compared to most competitors out there in the space. And so, by the way, to close that loop, I also invest for culture, right? So I want to feel like I believe in the cultures of Apple, other companies that I'm invested in, right? Some people have mixed feelings about Starbucks. Some people love them, some people hate them. But look at the culture of these companies. I think I personally am amazed by Starbucks. They're helping pay for college for a lot of their baristas. They're often on the leading edge of progressive reforms within business. But anyway, I hope I tied the loop, Megan, around culture, the importance of it, both for our company, The Fool, for all businesses, but also for us as investors.
David, can I jump in for just a second? A lot of the attendees today will probably go to fool.com for the first time, which I really commend you to do. But there's so much information on there. If I'm a newcomer to fool.com, what would you recommend that I do?
Thanks, Chuck. I think for most of us, if you're ready to invest, then I think if you go to fool.com, you can just surf our site for free for days and weeks and months if you want. I mean, we write articles every day for free that are out there on Yahoo Finance and MSN, and you'll see the Motley Fool explaining why a stock is up or down. And you can learn a lot that way. We also have free forums, so you can just ask questions. For most people who want to start a membership with us, they'll join Motley Fool Stock Advisor, which is our most common service. Thanks, Chuck. Yeah, and basically you can get started for basically, I think it's $100, $99 a year. I think that that's one of the better investments that most people could make personally, because my brother Tom and I are picking a new stock each month and also looking at our past holdings and saying, which do we like the most? And so there's a steady stream. Netflix streams entertainment. We stream stock picks through Stock Advisor. But Chuck, I'll close that by saying that we have a new business called theascent.com. And so for a lot of people who are looking for a better credit card, better interest rate, who have financial decisions that are personal finance in nature, right, which is often more relevant to college seniors than like what stock they should pick. Take a look at The Ascent. I'm really proud of that business. It's been a ramping thing for us. We started 3 years ago. If you Google the phrase credit cards today on the internet, I'm not doing it right now, but I think you'll find that the #1 SEO position on the internet is The Ascent, which, by the way, is not even our core business, but it shows that you only rank high for Google if people trust what you've done, if you've done it for a long time. So when we launched The Ascent 3 years ago, we didn't think we'd be ahead of American Express, Visa, NerdWallet, and all the others and be in the #1 pole position there. So for a lot of people, theascent.com might be more helpful initially, finding a brokerage account, for example, than just getting steady streaming stock advice.
Terrific. Thanks.
You're welcome. Thank you.
David, I've also had someone ask me privately, someone who actually knows about or saw your 7 talk. Those of you who don't know, David was one of our very first 7 speakers ever. We've got some 7 speakers on this call today, so other 7 speakers. But when David did his talk, he named 7 of his top choices of stocks at the time. And the person who private messaged me said, what would David tell us now? So I'm not sure you have your top 5 to 7 stocks you want to reel off, or whether that's something that would take more time to prepare, but someone has asked, would he do that for us?
Well, thanks a lot. So before I did that 7 talk, I thought deeply and researched deeply what I was going to say and do. So shooting from the hip here, of course, I don't expect to have a solid list of companies prepared for this. Let me see if I can briefly, this will be fun if I can manage to do it properly. I'm going to attempt to screen share. This could break. This may not end well. So am I screen sharing right now? You're seeing like all my stuff. Is that working?
It is.
Okay, great. So these were the 7 stocks that I picked. So in 2009, I will give a few stock picks now just for the fun of it. But please note here, let me blow it up because that's kind of an eye chart. So I typed them into Motley Fool caps. It was Morehead-Cain in 2009. That's the 9. And here they were. And you'll see Netflix was at 7. And Amazon was at 124. Netflix is up 46. Basically, we crushed it. One of those stocks underperformed the market. The score there in red is Baidu, which is a point behind the market averages. But you can see the S&P 500 since 10/26/09 is up 135%. So that's the stock market doing its thing over 10 or 11 years. But then you see the benefits of picking great companies. At the time, it was stressful. 2009 was really a bad time for investors. But notice that every one of those has at least doubled. And Take-Two Interactive, which is behind Red Dead Redemption, most recently I think of for video gamers, is up 10 times, right? 900% gain is 10 times in value. 100% gain is 2 times in value. So, and then you just see how Netflix has just crushed it, and Amazon. So I'm very proud of that talk because I feel a lot of pressure when I address a room full of Moreheads, the best people I know in the world. And so I woke up, I didn't sleep well the night before I did this, and I just kind of winged it. And I'm really happy about that talk. But in particular, I've always thought if anybody ever shows it again, a lower third showing where the stock was as I said it, because the market had been crushed. So people are probably like, he's making stock picks here in 2009. But now we see the benefits of buying during a tough time. So maybe rather than try to replicate what I did then, which might be hard, I can at least remind us that this is a similar time here in 2020, right? A lot of people feel stressed out. They see the stock market declining. They think that's really dangerous. That's exactly what was happening back in 2009. So happy to have shared the screen. This is on our free site, caps.fool.com. So, anybody could link to this or find this. But these were the 7 companies, and they've been awesome. So, but, if I were to just to look at, I'm going to unscreen share now. If I were just to look at most recent picks that we've made through our services, I was picking that list of stocks for companies that really I thought were very future oriented and had been knocked down hard. So I have more of a mix now, but most recently I picked Zoom, as I mentioned. Part of my approach, which we don't have time to talk about for investing, is I love to do something that seems against most people's psychology. Like most people would see Zoom, see it's doubled in the last 6 months and would think, oh my gosh, I missed it. I wish I thought about Zoom 6 months ago. I'm the guy who looks like he's late to the party buying now, but I'm going to be holding it for a lot longer than most people will hold Zoom. And so let's see how it does. It's not going to be as dramatic as Netflix or Amazon because it's a much larger company today than they were back then. But so that's an example. Netflix, I certainly love today, would buy today. Some of my favorite companies are over on Motley Fool Rule Breakers, which is the other service that I pick stocks for and run. And C Limited, which is ticker symbol SE, is kind of like Amazon / PayPal in the same way that Mercado Libre is for Latin America. C Limited is for East Asia. So Indonesia, Vietnam, you think about who the Amazon is out there, it's C Limited. So it's a $21 billion company. It's down a little bit from when I picked it a few weeks ago. Everything else is too. Peloton has been an interesting company. Got really controversial for its ad a few months ago. And now people start looking at distancing and indoors and staying fit. And all of a sudden Peloton looks like a smart company. There's a wide array of different types of companies that I pick. So I don't have my prepared 7 list for this call, certainly. Teladoc Health has been a big winner. I really like that. So this is a company that's a $12 billion company today. That means, by the way, that's the value of the stock. When I'm saying 21 billion for C Limited, that means if you tried to buy all of its stock, that's how much it would cost, right? It's called the market capitalization or market cap, which is a simple price tag that I look for. So it gives us a sense of different sizes of things, right? So a company like Etsy, which I also really like, is $5 billion. And then a company like, the largest provider of wind and solar energy today, Next Era Energy, another company I love, is $120 billion, right? So you should understand different sizes relative to each other. So when I talk about Teladoc Health, it's at just $12 billion. And it's, you know, it's distance medicine, right? It's talk to your doctor over Zoom instead of needing to take your child in and, you know, to the doctors. These kinds of, so I really like these kinds of businesses. Roku, really well set up. I'm always asking, as the world evolves and adapts, not just to the near-term COVID situation, which will pass, but just to some of the new technologies. I'm always trying to skate where the puck is going to be with my money. And I didn't have time for this, and I know we're over time, but I didn't have time to talk about how I lose all the time and how willing I am to be wrong. So some of the stocks that I've given you are going to be toxically bad today. You're going to look back and say, you know, David was totally wrong about Roku. I'm very comfortable with that. My superhero ability is the ability to lose constantly. And a lot of people are just not willing to do that. So there's a great line from Winston Churchill. You know, the secret to success is stumbling from failure to failure without losing your enthusiasm. That's me. And so you have to be willing to do that if you're going to take the approach that I take to investing, which I call rule breaker investing. And I wrote a whole book about it. And I do a podcast every week about it. So if you find yourself, you know, 101 level interested in stocks and what wins in the market over time, I recommend rule breaker investing. But I specifically subvert a lot of the rules people use to invest. I go anti-Buffett in some cases to do what I do. And that's not even true of a lot of us at the Motley Fool. Even at my own company, there are people that would think I'm crazy. Although I think that my performance has opened eyes for some skeptics, but I want to make it really clear there are many ways to succeed, many paths. So you're hearing a very angled one from me today. Some of it is good old-fashioned eternal verities, and some of it is new world crazy thinking and the willingness to lose constantly. I think I'm starting to overstay my welcome, Megan.
Not at all. Oh my goodness. I think all of us could sit here pretty much the rest of your day and take it up. And we are so grateful. First of all, our private messenger says, thank you very much for you know, winging it and giving us your ideas. And we, Chuck and I are very proud of you,
Thanks.
David.
That means
And
We
yeah,
talked the last couple of years, David, so it's great.
yeah, and we're very, very thrilled that you were here. And thank you again, not only for this and for being a Morehead-Cain mentor and for everything you do for the program, but again for the $1 million that you gave to the COVID response team in New York City. I mean, that's just very moving to all of us out here who can't really do much. So thanks.
Thank you.
Appreciate it.
Thank you, David.
David, you're the best. We appreciate
Thank
you.
you all. Love
All
my
right, thanks,
bread. Go
everybody.
Carolina. Thank you.
Yay, go Heels.